Have you ever tried to figure out if a business is actually thriving or if it's just quietly failing behind the scenes? Look, it is a massive challenge today, especially since the illusion of success is frankly just so easy to manufacture. I mean, a company can have soaring top-line revenue, millions in fresh VC funding, and a huge hiring spree, but still be fundamentally broken and literally hurtling toward a cliff. All those shiny vanity metrics and aggressive marketing campaigns, they can completely hide a dangerously high burn rate or a business model that's just decaying from the inside out. So to understand what's really going on, we have to cut through the PR spin and examine the actual underlying mechanics of the operation.
Welcome to this explainer. Today, we're moving way past those surface level metrics to uncover the deeper structural mechanics of business health. We're going to look strictly at how capital flows, how risk is managed, and how value is actually compounded within an organization.
We've got a great roadmap for you today. We'll start with what business finance actually is, then look at the financial statements, followed by analyzing financial ratios, cost and capital structure, and finally making better financial decisions. All right, let's jump straight into Section 1. What is business finance? At its core, business finance goes way beyond just the mere management of money. It's really the sophisticated, strategic allocation of scarce resources, designed to maximize corporate valuation while strictly managing risk. Think about it. Every single dollar a company possesses has a time value attached to it, right? And the finance function exists to make absolutely sure that every dollar deployed is generating a return that justifies its inherent risk. It's literally the fundamental difference between an entity that just exists to process transactions and an organization that actively compounds value over time. You know, it's super important to draw a hard line here between reactive accounting and proactive finance. Accounting is inherently reactive. It's that vital process of logging receipts, ensuring compliance, and recording exactly what happened in the past. But finance is entirely forward-looking. It leverages all that historical accounting data to model out what could happen tomorrow. We're talking rigorous capital budgeting, complex scenario planning, and strategic forecasting to determine if a company should, say, acquire a competitor, build a massive new factory, or just stockpile cash for an impending market downturn.
Moving right along to Section 2, the financial statements.
Think of the income statement like a meticulous report card. It measures performance over a specific period, detailing exactly how gross revenue flows down through the entire organization. It strips away the cost of goods sold to reveal your gross margin. It deducts operating expenses to find operating income, and then it factors in taxes and interest to finally arrive at net income. Now, sure, aggressive marketing might temporarily inflate that top line, but generating a strong, consistent bottom line, that requires real operational discipline and pricing power. Here's a great way to think about it. If the income statement is like a continuous video recording of the year's performance, the balance sheet is a high-resolution photo taken on the very last day of the year, and you absolutely need both of them to tell the full story. A company might have a stellar year of sales on their income statement video, right? But if the balance sheet photograph shows they're dangerously over-leveraged with massive short-term debt and completely lack liquid assets, well, that rapid growth is incredibly fragile. The balance sheet ultimately exposes the true structural integrity of the business. And that brings us to the cash flow statement, which is arguably the most critical reality check of the three. Why? Because profitability does not equal cash flow. Under accrual accounting, a company can book a massive $5 million software sale today and recognize that profit on the income statement immediately. But if those payment terms are net 90 days, the business won't see a single actual dollar for 3 whole months. If payroll and server costs are due tomorrow and the cash hasn't arrived, that highly profitable business is going to default. So the cash flow statement strips away all the accounting theory and shows you exactly where the actual cash is moving. Which leads us nicely into Section 3, analyzing financial ratios. Ratios are fantastic because they strip away those absolute dollar amounts, allowing you to accurately compare, say, a $1 million startup with a $1 billion enterprise right side by side. But more importantly, analyzing them together reveals the hidden story of the company's operational friction. For instance, you could have a business boasting incredible profitability margins, but if their liquidity ratios are terrible, they're effectively a highly profitable entity that might still go completely bankrupt before the end of the quarter. Alternatively, looking at efficiency ratios alongside profitability can reveal if a company is generating high margins just because they're coasting on old equipment, which, let's be honest, will absolutely catch up to them when a massive capital expenditure is required. All right, let's pivot to Section 4, cost and capital structure. You have to remember, every single dollar a company uses comes with an opportunity cost, and that establishes the minimum hurdle rate, also known as the cost of capital. If a business borrows money at 5%, any project they invest that money into absolutely must generate a return strictly greater than 5%. If it doesn't, they are actively destroying shareholder value. And this dynamic is deeply affected by macroeconomic conditions. When central banks raise interest rates, a company's cost of capital immediately spikes. That means previously viable expansion projects suddenly become financial liabilities and have to be abandoned.
So, managing the capital structure requires navigating this constant, high stakes tension between debt and equity. Debt is usually the cheaper form of financing, and it provides some pretty powerful tax shields, but it drastically increases the company's risk of bankruptcy because, well, those interest payments have to be made regardless of how bad sales are. Equity, on the other hand, is much safer operationally. I mean, investors aren't going to force you into default if you miss a quarter. But it is notoriously expensive because you're permanently diluting your ownership and giving away future upside. Finding that perfect optimal balance between the two is really the secret to minimizing the company's overall weighted average cost of capital.
And finally, we arrive at Section 5, Better Financial Decisions. Mastering these concepts isn't just an academic exercise. It forces a highly disciplined approach to capital allocation. It completely changes your framework for operational behavior. When a founder deeply understands capital structure, the choice between taking venture capital money to fund an expansion or just securing a traditional bank loan stops being a wild guess. They can actively calculate whether the permanent equity dilution of a VC deal is worth avoiding the cash flow pressure of a loan's monthly interest payments. It transforms vague business intuition into calculated strategic leverage. It's a real game changer. So I want you to treat your own career, your department, or your next venture like a standalone balance sheet. Ask yourself, are you generating actual cash flow or just paper profits? Are you overleveraged on obsolete skills while neglecting your long-term asset turnover? Ignoring these fundamental vital signs is the silent underlying killer of otherwise brilliant ideas. Take the time to audit your own financial health because understanding exactly how the machine works is literally the only way to ensure it doesn't break down. So looking at your own numbers right now, what's the first thing you're going to fix?